Life insurance death benefits can become subject to estate tax. Often there's three ways in which this would happen. One, the estate is the beneficiary. Two, the insured can exercise an incident of ownership alone or with another at the time of death or before. Or three, the insured transfers an incident of ownership by gift within 3 years of death. Usually you can avoid any of those three types of possibilities through the use of an irrevocable life insurance trust or an ILIT. However, this could also be avoided with an entity, and for a variety of reasons it may be better to hold life insurance within an entity. Now, while the value of the death benefit that's attributed to an entity interest that's retained would likely be included in the gross estate, the question is whether ownership and control of the entity may also be treated as an incident of ownership, which brings the remaining death benefit back into the estate. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Today's episode 183, is all about the use of life insurance within family entities. Now, I emphasize family entities because that's going to have significance as to how we analyze the way the IRS would view entities, as we'll see in a later slide today. But as always, this presentation is not intended to substitute for legal or tax advice. It is provided for educational purposes only. And if you have questions or would like a copy of these slides, please email me at griffin.bridgers@gmail.com. On to the presentation. So, we've covered this bit ad nauseum in prior episodes, but it's common knowledge amongst estate planners that the life insurance death benefit can become subject to estate tax if any of the following happens. One, the estate is simply the beneficiary of life insurance death benefits. Two, the insured dies holding any incident of ownership in the policy that could be exercised either alone or in conjunction with another person. And I emphasize that piece, in conjunction with another person, because that might rear its ugly head later on as well. Or the insured transfers an incident of ownership other than by bona fide sale within 3 years of death. If you check any of those boxes, any one of the three could cause the death benefit to be subject to estate tax. That's going to be significant if the exclusion amount is reduced by legislative action this year or next year. Now, oftentimes you can avoid those outcomes through the use of an irrevocable life insurance trust that's funded either with an existing policy by gift or sale to the trust, or maybe the purchase of a new policy by the trust, with the significant point that the insured cannot be a trustee or beneficiary, because by not having the insured be a trustee or beneficiary, it avoids attribution of any of those incidents of ownership to the insured. Now, for a variety of reasons, an ILIT may not be optimal, especially if the insured might want access to some of the benefits within the policy during life. Now, there's all sorts of issues we could get into on that, so we're really just going to scratch the surface here and look at the basic boxes we have to check here with the question of whether we could use an entity in place of an ILIT. Now, Code Section 2042 and its Treasury regulations does condone entity ownership in certain circumstances. Now, there's really, as an expansion of our three issues where the estate tax could apply to the death benefit, there's really three questions we have to look at here too. One is whether entity ownership that's retained by the insured would attribute incidents of ownership back to the insured such that 100% of the policy proceeds are taxable in the estate. And if not, would a gift of an entity interest within 3 years of death, especially a controlling interest, be treated as a gift of incidents of ownership? Then, assuming neither of those apply, would the entity interest include at least a fractional value of the death benefit? Now, this last point is probably the easiest to answer. Generally, the answer is yes, that the fractional entity ownership will virtually always include the fractional value of the death benefit, because really, that's the functional equivalent of naming the estate as a beneficiary of a portion of the death benefit. So, for example, If we had an LLC that was the owner and beneficiary of a $1 million policy, and the insured dies owning a 20% LLC interest, that means that that 20% LLC interest is going to include 20% of the value of that death benefit at the insured's death. So at least $200,000 would be included in the gross estate, in addition to 20% of the entity assets. Now, whether or not there's a discount there is another question that we're not really going to get into today, but the question really moving forward from this is whether any part of the remaining 80% could be attributed back to the insured through incidence of ownership by virtue of entity ownership. Now, the 2042 regulations directly address corporate stock but are silent on partnerships and LLCs. So, as long as the corporation is the owner and beneficiary of a policy, then there's no attribution through corporate stock ownership, and it doesn't matter how much is owned, whether it's 1% or even 100%, you don't have attribution in that circumstance back to the insured as a stockholder. However, if the corporation is just the owner of the policy and a third party is a beneficiary, then there can be attribution of incidence of ownership through shares if the decedent and the insured is also a controlling shareholder. In other words, they hold more than 50% by capital rights and voting power. Now, as I mentioned, the 2042 regs are silent on partnerships, but more often than not, what we're going to have to probably look at is the combination of ownership and control. So there have been some private letter rulings in this area, and we won't really get into those just because there's a lot of nuance to them. They're not really black and white, straightforward types of rulings. But out of those private letter rulings have come some general themes. One is that with partnerships, attribution may be avoided if the insured is a limited partner and not a general partner. And then for LLCs, attribution may be avoided if the insured is not a manager. Now, as with anything, there's a catch, and we're going to see that catch just because the catch reflects what's happened since those private letter rulings came out in the general world of estate taxation. And that is that when it comes to attribution of incidence of ownership, there's a theme with family entities where the IRS is now acting under a presumption that a family might act in concert. So even if an insured is not a GP or a manager of an LLC, what the IRS will often assume is that a family would act in concert to dissolve an entity and transfer ownership of a policy. So if you have 100% or even over 50% family ownership, then depending on the threshold to dissolve the entity, that could still create further attribution of an incident of ownership, depending on the ownership of the entity among the family as a whole. Now, in order to avoid that, language in the entity documents should make sure this cannot happen. In other words, that if the entity is dissolved, then in no situation will the insured participate in any decision regarding the ownership or control of that policy, and that maybe the policy cannot revert back to the insured and would have to be distributed to the other entity owners. And with that being said, that settles incidence of ownership just based on entity ownership to begin with. Now, if you have an issue with entity ownership, you might want to transfer entity interest to avoid that rearing its ugly head, but there could be the 3-year look back on gifts of incidence of ownership. So for example, maybe the insured transfers a policy to a single member LLC and then gifts interest. So would this be a gift of incidence of ownership by virtue of gifts of interest in that LLC? And the answer is yes, possibly. And really what it hinges on is whether the IRS would treat the transfer of the policy in exchange for an LLC interest as a bona fide sale instead of a gift. And the trend is towards denying that type of treatment where family members are members of the LLC. So much like we saw the presumption that family members would act in concert, there's also a presumption that there's no bona fide sale where family members are involved, even where there's an exchange of assets for an equivalent value entity ownership in an LLC or partnership. So in order to avoid that outcome and have a bona fide sale, typically you have to show a significant, valid, non-tax reason for making the transfer. And that can be a difficult hurdle when it comes to family entities as opposed to entities that are owned by unrelated third parties acting at arm's length. Now, beyond the 3-year look back, if you gift an entity interest and get beyond the 3 years, then you don't necessarily have an issue under Code Section 2035 anymore, but you now have to look at the fact that retained interest in a family entity could also create attribution of the entity assets, including the death benefit or the incidence of ownership under Code Sections 2036 or 2038. Now with those, that same bona fide sale exception rears its ugly head as well. And typically with the bona fide sale exception too, let's assume maybe you're selling the policy to the entity in exchange for cash or a note back. So even if you can meet that bona fide sale exception, there's strict compliance required when you compare the value of the policy to the value of what's received in exchange. So if you underestimate the purchase price, you could run into a situation where 100% of the death benefit gets included in your gross estate regardless of the fact that there was a sale. And it's really unsettled in this context how Code Section 2043 would come into play. That code section is designed to avoid double counting of the inside fair market value of entity assets and the outside fair market value of an entity interest. We've seen that in a number of the family entity cases, and it's pretty easy, to kind of look at that comparison when you have traditional assets with a fair market value determined at death, but it's really kind of unsettled when we look at this in the context of life insurance, how that might play out. So for the time being, key takeaway here is that you really need to be careful with a family entity to limit both control of the policy through incidence of ownership and access to economic benefits of the policy in excess of the proportion of entity ownership that's retained by the insured. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.